if what mostly backs the dollar is the debt, if the interest rates go up on the debt and the debt becomes worthless, that means that 93% of the assets that back the dollar aren't worth anything. And so what is worth something on the Fed's balance sheet is the gold, right? So then the value of the gold goes up when the value of the debt goes down. It has to balance out, and then all the purchasing power goes to the gold holders anyway. But you can't have a situation, especially in an endgame scenario, where interest rates go up and the purchasing power of the dollar goes up. It might go up in terms of other currencies that are also worthless, but who cares if the dollar index is at like 300 if the dollar can't buy anything and nothing that the dollar can be exchanged for, and the foreign exchange markets can be buying anything. It doesn't matter. Like, this is all a stupid accounting game where the physical reality is that nobody can afford anything.
In today's news recap, silver dropped as US 10-year Treasury yield neared 4.8%, highest since October 2023. Silver prices declined sharply by 2.15% to settle at 29.90 as the U.S. 10-year Treasury yield approached 4.8%, its highest level since October 2023, prompting a reduction in expectations for Federal Reserve rate cuts this year. Strong U.S. labor market data, including unexpected job growth acceleration in December and a drop in the unemployment rate to 4.1%, reinforced views that the Federal Reserve would likely maintain its current policy stance. The Labor Department's report highlighted improvements in key labor metrics, easing fears of market deterioration. Globally, the silver market remains under a structural deficit, with a 4% decrease in the deficit projected for 2024 to 182 million ounces. Total supply is expected to grow by 2%, driven by higher mine output from Mexico, Chile, and the United States, alongside a 5% increase in recycling due to heightened silverware scrap in Western markets. On the demand side, industrial applications, including electric vehicles, solar panels, and electronics, along with recovering jewelry consumption, are anticipated to drive demand to 1.21 billion ounces. Notably, physical investment is forecasted to drop by 16%, while exchange-traded products are on track for their first annual inflows in 3 years, bolstered by a 32% rise in spot prices this year. Technically, the market is under fresh selling pressure, with open interest increasing by 5.41% to 21,873 contracts. Before we dive into the best clips of the week, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
Okay, so interest rates are going to go up. And if interest rates go up, the price of bonds goes down. And when interest rates go up, that means the dollar gets stronger. And if the dollar goes stronger, then the Treasury could just like theoretically buy back all of its own debt, cancel it, and then we go back to zero and everything's fine and we start inflating again. I mean, that was the implication of it. So I agree with the technicals of that. It's theoretically possible that the value of U.S. debt goes down so much that the Treasury has enough dollars to buy it all back, and then cancel the debt. Okay, but then what happens in the wreckage of that? And Finance a Lot, he says this. He says this pretty explicitly. I don't remember the exact words he uses, but America goes back to its strong position. Suggesting that the reserve currency status isn't affected and everything goes back to normal, and that's it. And by him saying that it's a genius move, he's saying that everything's going to be fine after that. The big problem with that, just in a very broad stroke sense, is that this is an accounting gimmick, right? And what he's saying in this tweet is that all that was wrong with all this money printing and this debt monetization and all the inflation that has led to all the wars and all the malinvestment, all the destruction of property and destruction of wealth. It just depends how you count it, right? If you just cancel the debt and then buy it all back, then everything's fine. Like nothing ever happened. And that's really the mistake that the Keynesians make and all the other academic economists make that think they can control human behavior with equations. They think that, well, if you count the numbers in the right way and you do this and that and you massage things, then you can print as much money as you want and you can spend it on whatever you want. And the accounting world sort of like magically bleeds into the physical reality world, and you have this like magic potion. Right? None of that is real. Right? Accounting is a trick that we use to organize real assets in the world, so we know that where they are and how much they are and how much needs we can actually satisfy with this real stuff on planet Earth. We use accounting in order to organize things. The thing is, you can lie about the accounting. That doesn't change the physical reality of what's going on. Right? So, like, imagine, Elijah, that you have money in your garage. Right, you have like gold coins, silver coin. Maybe you do. I don't know. I'm not saying that you do, but maybe you do. And you put me in charge of them, right? To like as your accountant, and I'm supposed to like give you a note about how much money and real assets. Let's not even say gold and silver. Let's say like wheat and barley and food. And, that you're stacking for an apocalypse. Let's make it real more realistic. That you're putting me in charge of your bunker for the end game, for the apocalypse, and I'm giving you a statement. And when I give you this statement, like I give you a piece of paper for every 1,000 bushels of wheat that you have, and another piece of paper for every 1,000 bushels of barley, and then for gold bars, etc., etc. You have all this paper accounting, right? And let's say you trade these things with your other prepper buddies who watch Reluctant Preppers and Liberty and Finance, and you have this like internal economy. But let's say like I'm actually stealing your stuff from your bunker without telling you, because you trust me, I have the keys, and you're trading all this paper and you're trading with your prepping buddies, and then when it comes down to it, and the SHTF, and you go down into your bunker, you realize that I took it all. Right? The accounting that you're pretending that you have all this stuff and you're trading these papers with your friends, it's not going to change the fact that you don't have anything. Right? So when things are really bad, all of a sudden accounting does not match with what you have discovered the physical reality to be, and you're just as screwed as you were when you were trading these papers around and getting assets from that trade. None of it was real, right? And then you experience hyperinflation, and then it's done.
In today's news recap, gold demand in India slows, Lunar New Year fuels interest in other hubs. Gold discounts in India rose this week as consumers refrained from buying as local prices hit a month's high, whereas the upcoming Lunar New Year festival stimulated gold buying activity in other major Asian markets. Indian dealers offered a discount of up to $17 an ounce to official domestic prices, inclusive of 6% import and 3% sales levies, up from the last week's discount of $14 an ounce. Prices are high, so buyers are holding off on purchases. Anyway, the inauspicious Car Mass month in Hindu calendar is still going on, an Ahmedabad-based jeweler said. Jewelers were on the sidelines due to volatility in the Indian rupee and overseas gold prices, said a Mumbai-based bullion dealer with a private bank. International spot gold prices hit 4-week highs this week. In China, the world's top gold consumer, dealers quoted discounts of $2 per ounce to $9 premium on spot rates, down from the premiums of $4.50 to $10 charged last week. The Year of the Snake approaches, arguably an auspicious year and a perfect backdrop for further gold purchases. Independent analyst Ross Norman said Chinese investors will be encouraged by news that the PBOC have added gold to its reserves for the second month in a row, which may suggest the current price reflects fair value. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your gold and silver gear, from t-shirts to hats, designed by stackers for stackers, premium quality, shipping worldwide. Let us know if you'd like any specific designs, and remember, mine is bigger than yours.
What does it mean that the dollar is going to be weakening? It doesn't necessarily mean that the dollar is going to be weaker on a foreign exchange market. It could be stronger, but that is stronger relative to what? Well, relative to assets that are becoming worthless faster and faster and faster. So we could see, and I think we're going to see, the dollar become stronger and stronger on foreign exchange markets, and all the other currencies that are based on the dollar pour into the dollar itself. Because remember, other currencies are derivatives of the dollar themselves, and that's what the post Bretton Woods system has set up, right? The U.S. put, after it won World War, after it conquered the world, basically fiscally, it might not have conquered the world. In terms of placing its population all over the place, it sort of did do that. Not entirely, but what it did do is it stuffed its dollars into every other central bank. So it conquered them monetarily, right? And so that makes every other currency a derivative of the dollar, essentially, because every other central bank owns dollars, and that's what gives them their value. And that's hard for people to accept. That's how it is. So we should see that's going back to the dichotomy between accounting and real physical reality. We should see the world start to separate, right? As long as inflation remains muted in a way that the public isn't like koretegar. It's Hebrew. It's not calling out. It's not calling it out as a fraud yet. Then you can have the accounting world and the physical reality world sort of agreeing or looking like they agree, more or less, because people aren't checking. They're not checking their bunkers for what's actually there. But as these worlds separate, we should see the dollar get stronger in the accounting world, but get weaker and weaker in the real physical world. So the dollar index going up, but commodity prices going up even faster, then the dollar index goes up, and gold going up the fastest because it's the most liquid. That's what we should see. And that process, the separation of the accounting world from the physical reality world, where they reflect each other less and less and less, until everyone just says, like, the accounting world is fiction, forget it. Then, they'll let the banks trade the foreign exchange. And then at a certain point, like, even the banks say, like, this is an accounting gimmick, and I can't really buy anything with my salary anymore. So then all the banks go into commodity futures and real assets, and then you have like the global rush into real stuff, which is led by gold and silver because they're the most liquid. This is how it happens.
If you resonate with Rafi Farber's perspective on the looming collapse of the U.S. dollar and the critical role of stacking gold and silver as a hedge against economic uncertainty, we'd love to hear your thoughts. Are you preparing for what's ahead by stacking? And more importantly, are you bullish on gold and silver for 2025? Let us know in the comments below. Your insights could inspire others in the community. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.